Dividend Growth investors, bonjour. Mike here to help you invest with conviction so you can retire early and happy. Speaking of retire, today we are talking about 3 Canadian REITs that I love. Most retirees love REITs because their sole purpose is to distribute as much money as possible to their units holder. So this rhymes like having a nice paycheck that comes into your bank account every single month for most of them. Some of them is quarterly, but the 3 REITs that we're going to talk about today are monthly distributed, which is kind of great because you can pretty much build your budget around those kind of payments. You're going to be disappointed. I'm not going to talk about RioCan in my top 3, but actually I'm going to talk about RioCan. Let's tell you why it should not be in your portfolio. I know a lot of YouTube video has been done around RioCan right now because the yield is huge and it's a well-known established REITs. They own retail REITs across Canada. They're super strong, and the CEO kind of said, you know what, we're not going to let our shareholders down, and we're actually maintain our dividend. So it's all great, and then you focus on the yield, and then you think, oh, Mike, you're losing such a great opportunity if you don't look at RioCan right now. Well, let's put it with a different angle. If you look at the past 10 years, your paycheck increased by 4.3%. So RioCan, which is loved by any retirees, has only increased their dividend by 4.3% in 10 years total. So if you're going to settle for a job and ask for an annual raise under 0.5% year after year for the next 10 years, you know what? You might want to go work for me at DSR. I think I'm going to have something for you. I mean, this doesn't make sense, right? Your dividend is getting eaten up by inflation. And when you look at the stock price, well, then again, another bad news. Stock price hasn't done much before the pandemic, and now it has gone below below $15. So you're basically losing on the dividend side because inflation is increasing a lot faster than that. And then don't tell me, Mike, well, inflation is like 1% a year right now, so you're worrying about nothing. Well, if you look at your grocery store bill, let me tell you, inflation is a lot higher than that. And as a retiree, I don't think you're gonna buy houses, computers, and cars every single year. So while those things may not influence inflation right now, groceries and heating budgets and utilities will continue to go up a lot faster than 1%. So you're putting your money at risk, you're putting your retirement at risk. And this is why RioCan was not loved at DSR, not this year, but last year and the year before. So since 2018, we were like, meh, I don't think it's a good one. And right now, it's definitely not a good one for your portfolio. And I don't think that shopping malls are going to thrive in the future. So they have to reposition their portfolio. They have to find other growth vectors. It's going to be hard for them. And yes, they have more than retail. They have more than shopping malls. But those shopping malls are going to stay, and they're going to probably stay empty for most of them. So this is why it's not part of my top 3. So now moving on to the interesting part of this video. First one that we're going to look at is InterRent, ticker IIP.UN.TO. Dividend yield 3.5. You're going to tell me it's not too much. Yes, but consecutive dividend growth increase since 2014. So 6 years with a paycheck that is increasing. The distribution is monthly, and most importantly, it's a very solid apartment REIT. InterRent is mostly based in 2 places where economy is thriving. So we're talking about Ontario and Quebec, most specifically Montreal and Toronto. This is pretty much the only 2 markets that they know very well. They have over 11,000 suites over spread across those 2 provinces. So they decided to focus on a small market that is doing very well and offering great apartments. Their growth vectors is all about acquisition and development. They also improve their properties, and one thing that I like about them is they try to include a lot of technology in terms of services for their tenants. So this helps a lot if you need services or if you have any question, you can use an app and so on. So this is a great way for them to convince new tenants that have good jobs to come over. And one thing that is super important right now, what they do is they do a lot of improvement in their buildings or the surrounding area. So this means that they can obviously rent their properties at a higher price, but it will also attract millennials or professionals, people that have good job. And right now with the economy that we have, a lot of people may think, I'm not too sure it's the right time to buy a house, let's rent a little bit more, and they're gonna go for a nicer apartment, which InterRent provides, and this is also part of their business model. If you look at the trend, well, right now you can see that the stock price has dropped. Obviously, there are concerns about the economy. There are also concerns about the fact that most apartment REITs will have to offer no raise or a little bit lower rate for their apartments this year to convince people to come over. There's also a risk that there's also a possibility of having too many properties, and then the demand is too high for the offer is too high for the demand. So this could create kind of a struggle. But when you look at how fast they grow their revenue and how fast they grow their dividend, this is definitely a company that you want in your portfolio if you're about to retire. If you're worried about the dividend payment, well, you don't have to, because the assets is growing pretty much at the same pace as the fund from operation per unit. You know, a lot of times investors will look at fund from operation and it grows because the REITs is acquiring companies and then it grow better. But if they finance it with more units, the FFO per units is not increasing. So in this case, we're talking about 22% annualized increase since January 2010, and the little dots that you see is the payout ratio based on the adjusted fund from operation. You can see that while the dividend is increasing, we're keeping the payout ratio around 70%, which leaves enough room to do both: continue to grow their business and on top of it continue to grow your payout, which is pretty nice. InterRent has a solid balance sheet. As you can see, as it grows, its debt level is reducing. So we kind of like that when you're about to enter in a recession. So they're well positioned. They will be in a good position to either refinance and then look for more opportunity. So this is also another great point about InterRent. They are sitting on some cash as well, so they have liquidity available. Then again, you're looking at a company with a solid balance sheet, liquidity, great growth perspective in Montreal and in Toronto area. So we're talking about a very solid REITs offering you 3.5 yield. Now, moving on to another one that is a little bit more generous. Canadian Tire REIT pays 5.5 yield, which is pretty cool, and dividend growth since 2015. Another REIT that is paying monthly. Well, this one is pretty straightforward. It's all about Canadian Tire, right? So we're talking about an icon in the retail commerce in the Canadian landscape. And I personally like Canadian Tires because they have strong brand recognition, but one thing that they have that will probably help them to battle against Amazon and other e-commerce is they own a lot of their own brands. So you cannot buy Motorcraft or Motomaster pieces elsewhere than at Canadian Tire. And this provides them a very strong advantage. Since the beginning of the pandemic, Canadian Tire has pushed a lot on its e-commerce. It has thrived by 400% in Q2. We're talking about major investment over there. So it's kind of speeding up everything here, and it protects them a little bit more against competition from other e-commerce. As you can see, Canadian Tire REITs is all across Canada, mostly focused in Quebec and Ontario, so two provinces where the economy is doing well, and then they have another like 80 properties in Western Canada. which should do well at the same time. So we're talking about 357 properties. Besides Toronto, Montreal, and Calgary, they're well diversified among small, medium, and urban size. They deserve pretty much all kind of community across Canada. They're well established, so you don't have to worry about their coverage. In terms of stock prices, similar to InterRent, we see that it was fairly stable and then it got hit. It's already on the rebound, which is also a good sign telling you that the market is believing in Canadian REITs, which is a good thing. But when you look at the trend in revenue and the trend in dividend, it's growing consistently year after year. And this is what you want when you look for a REIT, especially a REIT that is offering a 5.5 yield, which is quite generous, but at the same time, you want to make sure that it keeps going on, which is the case. When you look at the payout ratio, we're around 75, between 75 and 80%. The annual distribution is increasing by 3-4% a year. Obviously, considering the pandemic, don't expect a huge increase in 2021, but the company has plenty of room to pay more increase in the future. So when you're looking at their balance sheet, their debt structures is mostly focused on units and equity, which is a good thing. This means that they have lots of flexibility if they want to borrow against their properties. They also have 300 million access to 300 million in revolving line of credit. Then again, great for them, so they can move around and they have more flexibility, and you don't really have to wonder if Canadian Tires are going to pay their rents. They're pretty solid right now, and their latest quarter have been shown that their stores are still open. They're going to make money this year again, and you don't have to worry about seeing a bunch of Canadian Tire being closed anytime soon, which is also very good news. Now, moving on to my favorite REITs, and it has been one of my favorites since a long time. DSR members knows that, so it's not the flavor of the month, even though the stock is trending. Granite has been among our favorite one for several years now. Yield slightly under 4%, but dividend growth since 2012. It used to be pretty much Magna International REITs. They had, like, when they were in 2011, they had 94% of their properties that were rented to Magna, which was a huge risk. So management was smart about that. They decided to move forward and establish a real plan to deleverage their exposure to Magna International, and today Magna is still their largest tenants, but only at 31%, while the REITs increase in value from 1.9 billion in assets up to now 5.3, which is quite a feat to realize in less than 10 years. Most properties are modern logistic properties and special purpose properties, so it's an industrial REITs. They're looking at large businesses, obviously. But what I like about it is well diversified among several segments. And now, so what you have is about 60% of revenue coming from North America, so Canada and the US, but you still have international exposure, which is kind of great. It helps them if there's any recession in specific countries, they're still well diversified. Another thing I really like about Granite REITs is while they deleverage their exposure to Magna, they increase their exposure to Amazon, which is a very smart move. I think that going forward, this is one of the things that we want to see for an industrial REITs, a little bit more of distribution center, which will help them to grow their business and have stable tenants. So their top 10 is still representing 63% of annualized revenue. It is still a risk, especially when you consider Magna. I mean, Magna is a great business, but it's evolving in the automobile industry. Right now, we're kind of a big recession right there in this industry. It's going to last maybe a couple of years. Do I fear for Magna? I don't. I personally have Magna in my portfolio, so I don't really mind right now. It's one of the best and largest OEM auto parts maker. They're going to stay that way. Auto constructor tends to actually concentrate on fewer suppliers, and Magna will be on top of the list. So they're actually well positioned to make acquisition and then just consolidate their place among auto builders. So I'm not too worried about Granite, but just always take a look. Make sure that you want to have more e-commerce dealing business with Granite than you want to have automobile businesses, that is for sure. This one, as opposed to the other REITs that are in my top 3, has not suffered on the stock market. Well, very quickly during the March crisis, but now it has fully recovered. It's more than a V recovery actually for Granite. It's actually going up, especially because we have an interest in the e-commerce side. You can see that there's a strong trend in revenue as well. And while it doesn't show on this graph because they did pay a special dividend in 2019, the dividend growth rate keeps increasing year after year since 2012. In terms of distribution and payout ratio, we're looking at something around 75%. Then again, pretty stable. You can see here the distribution per unit, which is a lot clearer on this graph from 2013 to 2020. So we went from $2.11 to $2.90, which is very good. Payout ratio is still under control, so you don't have to fear about what's going to happen next for Granite. What's going to happen next in 2021, you're going to have another dividend increase. So in terms of balance sheet, it is well diversified in terms of debt maturity, so they're not going to get killed by a specific year where they have to pay off debts or reissue new notes. And they also have about $1 billion in liquid assets, available liquidity, which is spread between cash and equivalent and credit facility. So basically, what they're telling us is that they're going to keep growing with new projects, acquiring new properties, and they're well in place. They have flexible assets that they can move around if they need liquidity. So everything that you need as a retiree, still yield, you're going to tell me, a lot lower compared to RioCan, but also a lot safer, and this one is going to increase. So thank you for watching this video. Now it's your turn. I'm curious about your favorite REITs, Canadian REITs. Do you have any other suggestion there? WPT Industrial, for example, or Summit REITs. What do you think about those? Let me know in the comment. Smash the like button. And next week, I'm coming back with a similar video about my top 3 in the US side, and you can expect that I'm not going to talk about Simon Properties Group, right? All right, so until next video, stay invested.